All right, let's get started. I'm Mitch Goldberg. You're watching Be the Boss of Your Money. Thank you so much for joining me. We've got a couple of things here. All right, we're good. So, markets down. Markets down pretty substantially today. Dow down over 500 points, and it was just a confusing day because investors got exactly half of what they expected. So let me explain. Today is Fed Day. The Federal Reserve, the actually more specifically the FOMC, Federal Open Market Committee, had their meeting today. They meet 8 times a year. Okay, today was one day, one of them, and it's a 2 day meeting. They're not always 2 day meetings. This one was a 2 day meeting yesterday and ended today. At the end of the meeting today, Chairman Powell comes out and announces the Fed policy, how much they would raise rates, and what they see or expect going forward. So the Fed raised rates 0.75%, also known as 75 basis points. So the short term federal funds rate is now at targeted 4%. So this is the highest since 2008. Okay. Makes sense. Inflation's is up there. So the interest rate should be higher to adjust for that. So that's one thing. But what the market was expecting, and this is where I want to say the expression "hope springs eternal." This has happened the last 2 or 3 rate hikes, where investors expect the Fed to get to a point of saying, very soon or at the meeting that we've raised rates enough. We want to see what effect they're going to have on the economy, or we see signs of economic slowing, or we see signs of moderating inflation, and where if we're not done raising rates, at least we're done, for a while. And Chairman Powell came out and said, any thought of the FOMC slowing down or stopping its interest rate hikes is premature. And in fact, he said we would rather overcompensate for inflation by raising rates a little too much than undershoot raising interest rates. So that tells you everything you need to know. This thing, hope springs eternal. When hope springs eternal, it means our expectations are high for a specific outcome, and we get shot down when we don't get the outcome. So the outcome is this: the Fed's going to be raising rates for longer than investors expected. So everything gets pushed back when the stock market stops going down, when we could start getting into interest rate cuts, and a new bull market. That has all been squashed for now. There's a very good likelihood that the gain we had in the last week or two will be repealed. Today was, last Friday, the market was up. The Dow, I'm going by, was up over 800 points, up over 800, but today down 500. But so far this week, I would say the Dow's down probably about 700 or 800 so far this week. It's only Wednesday. So there you have it. Fed did raise interest rates as expected to an extent that was expected, 75 basis points or 0.75%. But the Fed also said, oh, no, we're not ready to slow down. We're not ready to acknowledge any slowdown or any moderation in inflation. We're going to keep going. So every meeting, investors get their hopes up. It says, this is it. This is the last one. Everything is going to be great. We can go back to the big party. No, our hopes are dashed again. And that hurts. That's why stocks went down. So that is what's going on. That's why the market went down so much. So when does the Fed stop raising rates? I mean, it's still expected that the Fed will raise rates 50 basis points at their next meeting in December. And their next meeting is, I think, February 1st, that they'll raise rates by maybe a quarter of a point. Now you have to start thinking maybe that'll be a half a point, and the Fed will keep going with quarter point to half point hikes, past the middle of next year. So we have to reconsider when the Fed gets to its terminal rate. The expectations is the Fed gets to about 5.25% on the Fed funds rate. Maybe we need to start thinking 5.5, 6. of course, the data will dictate what happens, and you never know. But every time there's an employment number or an inflation number that's coming out, investors go, we're going to see things moderate. Or if something inflationary comes out, a higher than expected employment figure or higher than expected actual inflation figure, like the CPI, Consumer Price Index, investors go, oh, well, that's it. That's going to be the peak, and now we're going to go down. But it doesn't happen. Things are staying high. The things we don't want to stay hot are staying hot. So it's just, the old expression on Wall Street with interest rates, with Fed policy, was lower for longer. Now it's higher for longer. That's the difference. That's why stocks went down. And that's why I expect the last few weeks of this upside that we had to probably be repealed. We're going to go over the day's events, a couple of top stories. We're going to go through this pretty quick. So let me pop up the banner here. Let's roll the intro, and then we'll take a quick but deep dive into a couple of things. While you're watching, if you don't mind, give us a thumbs up, an applause, a heart, whatever reaction is available to you, depending on which social media platform you're watching on. That helps to spread the word of the work we're doing here. Your friends, your contacts will see what you're watching. Maybe they'll benefit from it too. It's all educational, no sales here. That's one thing. The other thing is, if you have any questions, please ask me in the comments. I love hearing from you. It's the best part about doing this. With that said, let's go with the intro, and then we're going to do a couple of quick things. We're going to go through some quick good things. All right. On my screen, it looked like the intro froze for a second. That happens sometimes with streaming. Remember, this is not TV. This is streaming over social media, so it's not quite to TV quality and reliability just yet, but it is getting better. But anyway, I love having my own live stream. I love having my own show. I always wanted a show. Now I have a show. That's pretty cool. I have a show. Oh, what's the show? What's the name? Be the boss of your money. It's about money. It's about you taking control of your money. Maybe I should have called it Money Control or Mission Money Control. Be the boss of your money is good. I'm kind of stuck with it, so I've been marketing it, and that's what I'm going to do. So let's take a look at the boards. Wait, let me just go to a different screen. Make this a little bigger so you can see it. All right. Pop myself up here. Get rid of the icons there. Okay. Central bank's new statement hinted at potential change of how it's significant. Here it is. Jerome Powell dismissed the idea that the Fed may be pausing soon, he said. That's what got the market going down. And how did the market do? Well, let's take a look. Dow down 500, 1.5%. NASDAQ got Nasdaq'd. I mean, that was down a lot. Let's get that out of here. NASDAQ went down 3.33%. That's a big drop. S&P down 2.5%. That's a big drop. Tech stocks took the brunt of it, which were the winners last week, and everybody said, "Oh, they're coming back." This is why I always say, please don't get carried away in short-term enthusiasm. It's great that tech stocks rebounded a little bit off their lows, especially in light of last week's drubbing from Facebook, Amazon, Alphabet, and Microsoft. But nonetheless, these are just all blips on the screen, and you really need to be thinking in terms of longer term investing. Okay, not just buy back all your tech stocks and expect them all to run back up to their old highs in like a month and everybody be happy again. It's going to take years for these stocks to come back, if at all. Okay. That's my opinion. 10-year yield up a little bit, 4.1%. The VIX was only up a little bit. Now, this is interesting. This actually may be one of the most interesting little factoids of the day. Okay. The VIX is up 0.05. When you see the NASDAQ go down 3.5% and the S&P down over 2% and a down 500-point day on the Dow, you would expect the VIX to be trading at like 30. Would go up a lot, which would foretell more pain is expected. But the VIX is holding in there. It's tough to read this because if you ask me, what does VIX down mean? It means investors believe that the market's going to recover and go back to its short-term winning ways. That's my interpretation. Gold going down means that inflation is under control. So it's a lot of mixed signals, and that's why investing is so tough. That's why, if you want to make things easier on yourself as an investor, if you want to make things easier on yourself as an investor, think long term, focus long term. That'll make it easier on you. This way, you don't pay attention to the vagaries, the day to day up and down of the market. Okay. Extend your time horizon. You'll be, I think, a lot better off. So let's take a look at the bond market. Okay. Short term treasuries are actually down a drop. The shortest of short term are down a drop, but the rest of the yield curve was up a little bit. 2 year still in the 4.6 range, 3 or 4.5%. But going out to 30 years, you're still getting over 4%. Personally, I don't want 4.1% for a 30-year bond when I could go, 2 years for 4.6%. Now, if interest rates go down a lot and stay down a lot, that 30-year yield of 4% will be attractive. But I'm not going to worry about that right now. Okay, let's take a look at the watch list. Let's go to this one. This is what I want to show you. Okay, interest rate products. All right, 30-year mortgage 7.12%. The 2-year, 10-year, 2-year spread. That's the inverted yield curve, negative 0.52. So the yield curve has been getting wider. You remember, it used to be 0.3, 0.35, 0.4. Now it's 0.5. So it's a pretty very steeply inverted yield curve, which still portends economic slowdown and recession. And the BLV, this is something that's worthwhile taking a look at. This is the Vanguard Long-Term Bond Fund. It's an exchange-traded fund, long-term bonds. How are long-term bonds doing this year? They've been such a great place to be over the year, right? Let's take a look. Down 32%. I mean, have you ever seen someone lose 30? Seriously, have you ever seen someone lose over 30% on a quality bond fund, investment grade bonds? I personally, in my career, I have never seen an investment grade bond fund drop 32%. I've seen plenty of bond funds drop much more than that. Junk bonds or bond funds that use leverage to juice returns, which I avoid. But I've never seen an investment grade fund, a fund that invests in what's considered investment quality bonds, go down 32%. This is why it's such a tough year for investors, because even though stocks are down a lot, you would have expected that the bond component of your portfolio would have held up, maybe even appreciated in value a little bit to help moderate the downside in the stocks and help moderate your portfolio's performance. But you're not getting that. Year to date, down 32%. Do you know that's worse than the stock market? Holy, you know what? That is a horrible return. The S&P 500 didn't go down that much. By the way, you can't invest in you can't invest in an index, but you could invest in a security that tracks or mimics an index. Did you know that? Yeah, I have to always make sure I say that in the live stream. Okay, so let's take a look at some noteworthy news. Okay, of the industrial stocks that I follow, only one was up. Boeing was up today because they raised their forecast for cash flow for 2023, and because orders are going up a lot, rising orders. So if it had been a good day in the market, Boeing probably would have been up $10 to $15 a share. It was only up $4, which is a good day by any stretch, up over almost 3% on the day. Not a bad day, but good news from Boeing. Basically, the MAX jet orders are coming in and they're getting back on track. Wells Fargo is the next one I want to talk to you about. Okay. The news for Wells Fargo mortgage staff brace for layoffs as U.S. loan volumes collapse. When I say loan volumes, I mean, let me get the quote. I mean mortgages. Okay. So Wells Fargo, not bad. It was down 7 cents on the whole day, despite a tough day. Bank stocks, by the way, held up relatively very well today. And it's perceived as good by shareholders if Wells Fargo was about to basically fire everybody in their mortgage division, because the mortgage division has become a loser all of a sudden. I'm not saying the people who work there are losers. I'm just saying the mortgage division. Mortgage originations have basically ground to a halt. And speaking with attorneys I know who do real estate closings, realtors I know for residential real estate, they are telling me there is nothing going on. Any deal that is closed, it's because it was already in the pipeline for a while, but there is nothing new going on. Mortgage rates, I think, year over year are down like 90%. So it makes sense that a lot of banks are just going to be slashing and burning their headcount in the mortgage departments. Okay, so that's newsworthy. And that's it. I think I covered everything. So thank you very much for watching. I hope you got something out of this live stream today. It's called Be the Boss of Your Money. If you have any questions or something you'd like me to cover, please hit me up in the comments. Some of you have sent me some questions about treasury bills, about T-bills. I see it. I will get back to you, and I'm looking forward to our dialogue. And for the rest of you out there, hit me up in the comments, say hello, whatever. And thank you very much for watching. I'll see you tomorrow.